Welcome to the channel. Today we're diving into the world of hedge funds, those titans of Wall Street. We're talking billion-dollar portfolios, high-stakes trades, and enough financial jargon to make your head spin. We're going to pull back the curtain and reveal the insider secrets that can take your portfolio to a roar. Things are about to get wild and unpredictable. What exactly is a hedge fund? In essence, a hedge fund is a pooled investment fund. Picture a big pot of money. It's filled with stocks, bonds, derivatives, and all sorts of other financial instruments. These funds are typically open to a select few, the high rollers, the accredited investors with deep pockets. What sets hedge funds apart is their relentless pursuit of alpha, those outsized returns that leave traditional investments in the dust. They employ a wide range of strategies, from long-short equity to global macro, all in a bid to beat the market. Think of them as the Navy SEALs of the financial world, highly skilled, highly trained, and always on the lookout for an opportunity to strike. They don't just ride the market wave, they anticipate it, they surf it. Sometimes they even create the darn wave. For instance, consider George Soros's Quantum Fund, which famously broke the Bank of England by shorting the British pound in 1992. Or think about Ray Dalio's Bridgewater Associates, which has consistently outperformed the market with its unique pure alpha strategy. Throughout this video, we're going to break down these complex concepts into bite-sized, actionable pieces that you can use to elevate your own trading game. Understanding market trends is like having a crystal ball, albeit one that requires a bit more brain power. Market trends are the underlying currents that drive asset prices up, down, and sideways. Hedge funds live and breathe market trends. They employ armies of analysts and data scientists to identify, analyze, and capitalize on these trends. They use sophisticated tools and techniques like technical analysis and sentiment analysis to predict where the market is heading. Think of it like surfing. You wouldn't just paddle out blindly and hope for the best, would you? No, you'd study the waves and wait for the perfect moment. By understanding the forces that drive market trends, you too can gain an edge and start making waves in your own portfolio. For example, during the 2008 financial crisis, some traders identified the housing market bubble and shorted mortgage-backed securities, making significant profits. More recently, traders who recognized the potential of tech stocks during the COVID-19 pandemic capitalized on the surge in companies like Zoom and Amazon. In the next chapter, we'll delve into some of the specific tools and techniques that hedge funds use to analyze market trends. We've talked about making money, but what about the risks involved in the process? Hedge funds are masters of risk management, constantly refining their strategies. They understand that in the game of finance, you can't win every hand, but you can manage your losses. One of their favorite tools in the risk management arsenal is diversification, which spreads risk. They spread their bets across a wide range of assets, from stocks and bonds to real estate and commodities. For example, Bridgewater Associates, one of the largest hedge funds, invests in different industries, geographies, and currencies to reduce exposure to any one particular risk. Another key technique is hedging, which is where they get their name from. Hedging is like taking out an insurance policy on your investments, providing a safety net. For instance, Paulson & Company famously hedged against the subprime mortgage crisis, making strategic bets that offset potential losses in other areas of their portfolio. Think of it like this. You buy a stock, hoping it will go up, but you also buy a put option, which gives you the right to sell that stock at a certain price. If the stock goes up, great. You make a profit. If it goes down, your put option will cushion the blow, minimizing your losses. And of course, no discussion of risk management would be complete without mentioning stop-loss orders. These are automated orders that sell your investments if they fall below a certain price, limiting your potential losses. For example, Renaissance Technologies uses sophisticated algorithms to set stop-loss orders, ensuring they manage risk effectively. Managing risk is just as important as generating returns in the financial world, because you can't enjoy those sweet, sweet profits if you're constantly blowing up your account. Let's talk about the future of finance, because the hedge fund industry is at the cutting edge of technological innovation. We're talking algorithms, artificial intelligence, big data. It's a revolution in the making. Hedge funds are leveraging technology to gain a competitive edge in every aspect of the trading process, from identifying opportunities to executing trades and managing risk. It's a game of precision and speed. One of the most significant advancements is algorithmic trading, where computers automatically buy and sell securities based on pre-programmed instructions. For example, Renaissance Technologies, a hedge fund, uses complex algorithms to make rapid trades. These algorithms can analyze vast amounts of data, identify patterns, and execute trades in milliseconds, as seen in high-frequency trading firms like Virtue Financial, far faster than any human ever could. It's a new era of trading. And then there's artificial intelligence, the real game changer. AI-powered systems can learn from past data, adapt to changing market conditions, and even predict future price movements with remarkable accuracy. For instance, firms like 2 Sigma use AI to forecast market trends. Technology is also leveling the playing field, giving individual investors access to tools and insights that were once reserved for the Wall Street elite. There are now countless trading platforms and apps that offer real-time data, charting tools, and even algorithmic trading capabilities, all at your fingertips. It's never been easier to trade. Embrace the future. Because in today's market, the traders who harness the power of technology are the ones who will come out ahead. Time to put everything we've learned into action. Let's take a look at some real-world examples of successful hedge fund trades and the strategies behind them. Remember John Paulson, the man who made billions betting against the housing market in 2008? He saw the warning signs and took a contrarian bet that paid off big time, changing his career forever. Or how about George Soros, the legendary currency trader who broke the Bank of England in 1992? He recognized an imbalance in the European exchange rate mechanism and made a cool $1 billion in the process. These are just a couple of examples, but the key takeaway is this. Successful hedge fund trades are rarely the result of luck or intuition. They're the product of rigorous analysis, disciplined risk management, and a deep understanding of market dynamics. By studying these case studies, we can gain invaluable insights that we can apply to our own trading strategies. Even the best traders in the world started somewhere, often from very humble beginnings. They made mistakes, they learned from their losses, and they constantly refined their strategies to improve. So, don't be afraid to experiment, to test different approaches, and to find what works best for you in the long run. There you have it. We've journeyed into the exciting, sometimes intimidating world of hedge funds, and we've emerged armed with the knowledge and strategies to trade like the pros. Remember, you don't need a billion-dollar portfolio to succeed in the market. What you need is a solid understanding of market trends, a disciplined approach to risk management, and the willingness to embrace new technologies. So go forth and conquer the market, but most importantly, have fun doing it. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more insider trading tips and strategies. See you next time.